Today in this video, we're going to answer a question that you might have about investing and what strategy and approach you should be taking. Should you be maxing out your retirement accounts or should you be building liquidity? It's a great question, Ryan. And does this apply to a certain age group, or is this really kind of a universal question anyone would be asking as they're trying to save for the future?
Yeah, it could be a universal question no matter what your age is. And I've heard many different schools of thought on this. And some people the younger you are, some people just don't want their money, quote unquote, locked up until 59 and a half. And then if they want their money, then they have to pay taxes and potential penalties on that money. So I think a lot, it does depend on people's situation, but I've heard advisors in my industry who don't want their clients or themselves to save in any retirement accounts because it takes away that liquidity option to be able to do with that money what you want. So some people need that discipline to lock it up for a long time and put it in a retirement account, but then some people want to generate income, or they can still invest in the market and it not be in a retirement account. So maybe they want to generate returns and just pay the interest payments or the qualified dividends on an annual basis, and then have that step up in basis each year, and then only pay capital gains potentially one day on the gains of the account. So, and that's a whole nother topic is, okay, the taxes of capital gains in retirement. Well, capital gains rates are 0, 15, and 20%, and then potentially a little bit higher if you're in the highest income bracket. So some people may say, well, I want it in a brokerage account because when I take it out in retirement, I'm not going to have any quote unquote taxable income. So I can take this money out at a 0% capital gains rate. So there's an argument there on both sides of the fence.
All right, well, let's kind of look at both sides. And I want to start out with the maxing out your retirement accounts, because this is a thought that has been around for a while, right? And typical hey, rule of thumb is put as much in there as you can. So you mentioned the word discipline. Is that the main reason you do it? I guess there's got to be other benefits to maxing out these retirement accounts rather than just, hey, you don't want to leave that money liquid because you might throw it away.
Yeah, and some people need that discipline. So I think discipline is one of the many reasons to max out your retirement, or again, the rule of thumb, again, depending on what person you listen to. Is it 10% of your income? Is it 15%? Obviously, the more the merrier. If you can get to the point where you're maxing out your 401k, hey, great. Again, just know that money is, you can touch it, but again, you pay the penalties in doing so. And sometimes recouping those penalties and taxes will take a long time to get back to where you were. But yeah, some people need that discipline to build it in. Some people need the tax benefit of maybe putting it in a pre-tax 401k or a SEP IRA or a solo or a 403b, a simple IRA. Again, there's so many different options there depending on what your employer offers for you, that you can put that money in and not pay tax on it today. So it lowers your taxable income. So if you make $200,000 and you put $20,000 into a 401k, then you're taxed at $180,000. So the math is, like, the concept, I should say, is fairly simple. Sometimes the math is a little like, okay, what benefit am I getting by doing this? But most employers, to put money into a 401k, they offer an incentive, a match. So if you put in a certain amount, then they match it. So many, many times we tell people, and again, this depends on how much income you're making and how much capacity you have to save. The no-brainer concept of a retirement account to me is at least capture the match. If it's a 5 to 4, if you put in 5, they put in 4. If you put in 6, they put in 3. Whatever that match is, I would say at bare minimum, you have to do to get the full match. Now, understand the match. Does the match vest over a certain period of time? Is it yours right away? So you need to know that if you leave, once you start doing a 401k, if you leave in a certain amount of time, they may recapture. They call that a forfeiture. They may recapture some of that match, and you may not be able to take all that with you. So just kind of know that going in as far as a retirement account goes.
And then on the other side, building more liquidity. What are the main goals or reasons for doing this, Ryan? Is it just to capture certain tax advantages later, or do you have certain goals in mind to really want to set this money off in a different pool?
Yeah, most of the time it's not the taxes later, because we just assume, hey, whatever it grows, we're going to have to pay capital gains. A lot of people don't know your capital gains rate is based off of where you fall in the marginal tax rate of the federal tax code. So wherever you're at in the 10, the 12, the 22, the 24, the 32, the 35, the 37, or whatever the tax rates are. But when you view this video, if it changes one day, but wherever you fall depends on what capital gains rate you pay. And if you can keep your taxable income in retirement below a certain amount, then those capital gains rates, those funds that you take out in the growth is going to be at a 0% rate. So again, that's where working with a good CPA and calculating that, like, hey, this is how much I've taken out. How much can I afford to take out and still fall under that 0% capital gains rate? So potentially this could be a giant overfunded Roth. It just depends on, again, your other sources of income in retirement. And it also depends on what the federal tax code is going to be. But capital gains rate has always been lower than what the federal income tax rate is. And they kind of work side by side in unison with one another. So again, working with a good CPA and knowing the ins and outs of that. But this is more of a concept. But going back to your question, so most people don't really necessarily save for what the tax rates will be down the road. The great thing about liquid accounts is there's really no limit on how much you can save in these accounts. I kind of joke with people, if you win the lottery tomorrow, you can put every dollar into a brokerage account. Now, will people do that? No, probably not, because you got to pay Uncle Sam, you got to go buy stuff, and people will have their hand out for you. But anyway, it's more of the concept than anything. So income doesn't matter. How much you put in does not matter. But it's also there if you have a venture that you want to do. And most of that times that venture is maybe like a real estate venture, like something pops up like, hey, I want to get involved in real estate. And you have that cash there to be able to use for something like that.
All right. Well, look, there's different strategies for everyone, right? And Ryan, how much is this? It's about a bigger conversation on diversification when you're putting together a portfolio for someone at Black Oak Asset Management.
Yeah, it's not only like what investments you own, it's what investments you own in which account, depends on how it is taxed, but then also the types of accounts that you have and how they are taxed. So there's a bunch of different ways to do it. And that's the fun part of my job, is navigating that and taking people through the pros and cons of each account and how they kind of go together. Whether it's now it goes together or down the road goes together, it's a puzzle, and we love helping people put that together.
Yeah. So if you want to sit down and actually have an advisor look over your portfolio, look at your goals, right? And help you figure out where you should be putting that money, where you should be making those contributions and saving moving forward. Now is a great time to do that. Speakwithryan.com is the website. Go there. You'll be able to get on the calendar, have a complimentary consultation, begin that conversation with Black Oak Asset Management. But hopefully this answers some of your questions. It's a great question, but one that does take a little bit deeper of a dive. So we appreciate you watching another episode of Perfect Game Retirement. Talk to you again soon. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of Black Oak Asset Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Black Oak Asset Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Guest opinions are their own and do not reflect those of Black Oak Asset Management, RFG Advisory, or Private Client Services. Guests are not affiliated with or endorsed by the firm. Roth IRAs and Roth 401ks are subject to eligibility and contribution limits. Contributions are made with after-tax dollars, and qualified withdrawals may be tax-free if requirements are met. Roth conversions are taxable in the year converted and may impact your tax situation. Investing involves risk. Consult a qualified tax and financial professional before making any decisions. Securities offered by registered representatives of Private Client Services, member of FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, Black Oak Asset Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.